Alright, welcome to the channel, my channel, which is for chapter. Today we will discuss chapter 10 for using financial planning and life insurance. We are using McGraw-Hill book 2022 in terms of copyrights. Okay, this one is financial planning with life insurance. Is publisher will be Kapoor, Levy, Hughes, and Hart. This is the 7 editions. That's quite a number of learning objectives today. It's going to be a long one. So there's about four of them. Number one is define the life insurance and determine your life insurance need. Number two, distinguish between the type of life insurance companies and analyze various life insurance policy with this company issues. Number three, select the important provision in life insurance contract and create plan to buy life insurance. Number four, recognize how the annuities provide the financial security. So this is standard of life insurance. Okay, that's what is life insurance. Objective number one. When you buy life insurance, you are making a contract with the company issuing the policy. For example, I have a life insurance with Sun Life. I buy that insurance, 100,000, let's say. That's the Sun Life, the company. You can also buy from Manulife, Canada Life, or Great West Life, or any insurance company in Canada. When you buy a life insurance, you're making a contract with the company issuing the life policy. You agree to pay a certain amount of money and the premium periodically. In return, the company agreed to pay you to pay a death benefit or start a lump sum upon your death to your beneficiary. What is beneficiary? Is a person designated to receive something such as life insurance proceeds from the insured. Purchase requires time, research, and careful thought. Life insurance is one of the most important expensive purchases you ever make. Therefore, it is important that you budget it for these needs, okay? Because everyone will die sooner or later. And regardless who you are, either you're prince or you're king or you're beggars or you're commoners, everybody will die. And the life insurance will help you to cover those expenses for your beneficiary, the people that you left over, okay? Okay, excuse me. What is the purpose of life insurance? Most people buy life insurance to protect the people who depend on them, financial losses caused by their death. Life insurance benefit may be used to: number one, pay off home mortgage or other debts at the time of death. Number two, lump sum endowments for children. Number three, provide an education or income for children. And number four, make charitable donation after death. And then provide retirement income, accumulate saving, establish a regular income for survivor, and set up estate plan and pay estate gift and taxes. Principle and psychology of life insurance. Over the years, insurance companies have compiled tables that show about how long their people live. Okay, using this table, company will make a rough guess. Usually they use mathematical calculation. We call it actuarial. There's the statistical analysis basically. The most common, there's two very popular statistical analysis software called SPSS and SAS. This is what I use when I do my master program as well as a doctorate program, doing predictions. The sooner, okay, coming back to here, use this table. The company will make a rough guess about the person's lifespan and charge him or her accordingly. This is how you're gonna get your numbers in terms of your premium charges. And then the sooner the person is likely to die, the higher the premium he or will still pay. How long will you live? Okay, this is an example. In 1900, American middle life expectancy is about 46.3 years. In 2017, expectancy is about 76 years for men and 81 years for women. So in Canada, the life expectancy for women is about 81. The life expectancy for men is about 80. So in Canada, as of today, okay. So I thought that it's changed, varies accordingly, but it's usually about that level. You can look at the statistic of Canada later, okay. This is to give you an example, the age here in terms of expected life in years, okay. Age of 35, percentage of living 43.2. For female is 47.3. If you notice this, most female live longer than men, okay, than male. Okay, this again here, male. The female always longer. Statistically, female always live longer. Okay, based on the science data. Do you need life insurance? Not everyone need life insurance. Before you buy life insurance, you have to decide whether you need it all. If your death would cause financial hardship for somebody, then life insurance is a wise purchase. Okay, make sure when you leave this part of the world, you do not burden your offspring, your families. Okay, that life insurance will help to cover that cost. Household with children usually have the greatest needs for life insurance. Single people who live alone or with the parents have little or no need for life insurance unless they have a great deal of that. They want to provide their parents, friends, relatives, or charities. Okay. Estimate your life insurance requirements. There are 4 general methods of determining the amount of insurance you may need. The first one is called the easy method, which is based on the insurance agent rule of time that a typical family will need approximately 70% of your salary or 7 years before they adjust to the financial consequences of your death. In other words, multiply your current gross income by 7. For example, you make 10,000 times 7. Okay, 70,000. Thing, which is the second method, thing, which is dual income or no kids method. You assume your spouse will continue to work after your death. Focus on ensuring the spouse will not unduly burden the debt when you should die. Okay. Number 3, non-working spouse method. Requires multiple by number of years before the youngest child reaches age 18 by 20,000. Insurance expert has estimated that extra cost of up to 20,000 a year may be required to replace the service of a homemaker in a family with small children. Family need or method. Number 4, which is family need or method, incorporate important factors about you and your family, such as social security number and your liquid asset. Through the estimate of your life insurance need, don't forget to consider the life insurance that you may already have. Okay. And then the type of life insurance coming. What are the things that you're gonna buy the insurance coming from? Okay, this first one, there's a stock life insurance company are owned by shareholders that are generally non-participating policy, that is non-par policy, life insurance that does not provide policy dividends. About 75% or of the 841 life insurance companies in the US are stock companies, so about 75%. Mutual life insurance companies are owned by policyholders, especially the sale participating policy or par policy. Life insurance that provide policy dividends. About 25% out of 841 life insurance companies in the US are mutual companies. I don't know I don't have the figures one in Canada yet, but once I have it, I will publish it for you. The type of life insurance policy. Both mutual and stock insurers are sold to basic type of life insurance. The first one called temporary, the second one called permanent. What is temporary insurance? It can be term, renewal term, convertible term, and decreasing in term insurance. This is what I buy because it's much cheaper. In terms of premium, it's affordable. That's number 1. It's affordable. Now, number 2, permanent insurance. It's known different types, including whole life, straight life, or in life, or cash value life insurance. So this is what permanent insurance can be limited to payment, variable adjuster, or universal life insurance. Other type of insurance policy, such as group life or credit life insurance, are the temporary form of insurance. Okay, when I was working for BMO Royal Sons, they give me a group life because it's temporary, because we are insured during your employment terms. So okay, again here let me look at the temporary one, renewal term. It has a limited payment. It is considered group life. Multi-layer level term, it says variable life. Other type will be credit life. Convertible term, which is adjustable life, which is endowment life, and we have a decreasing term, which means a universal life, and we have a return of the premium, a type of. Okay, the type of life of insurance policy. Term insurance, that is temporary life insurance, provide protection for a specified period of time, pay benefit only if you die during the period it covers, which may be 1, 5, 10, or 20 years, or up to age of 70. Often the best value of customers. The term is option that allow you what is a conclusion of the term or to renew another term. So example, 5 years. For example, renewal term is an option. Okay, this is allow you, okay, for multiple renewal term. For the multi-layer term, which is a straight term, guarantee you will pay the same amount premium for the duration of your policy. Conversion term allow you to change from the term to permanent coverage. Decreasing pays less to the beneficiary as the time passes. Type of life insurance policy. Return of premium term. Returns all the premium if you survive the end of the policy term. Okay, the whole life term is a permanent policy for which you pay a fixed premium each year for the rest of your life, may also serve as an investment. And then limited payment policy, charge premium for only certain length of time until the policy is paid up. And then variable policy, your premium payment are fixed cash value shares with the stock market. An adjustable life policy allows you to change your coverage as you need to change it, while universal life insurance is essentially a term policy with a cash values. Okay, here an example of premium comparison major type of life insurance from premium, protect for, okay, policy benefits as well as advantage. This is the difference in terms of category of the benefits: the term life, whole life, and universal life. It has lower premium, increasing with each renewal. Okay, this whole life high initial term but doesn't increase. Universal life, it has flexible premium. It protects for a specific period. This one is for entire life. This one is flexible time period. Benefits, policy benefits with death benefits only. For this whole life, we'll have death benefits and cash as well as loan value. For universal life, it has flexible death benefit and usually cash and loan values. Okay, advantages here: for term life, we have a low outlay initially and can be purchased of a large amount of coverage for a lower premium. Whole life, it helps you financial discipline, generally a fixed amount premium, and has a cash value accumulation. You can also take loan against policy. For universal life, in terms of advantage, it is more flexible. It takes advantage of current interest rate and offers possibility of improved mortality rates as well. Okay, in terms of disadvantages for premium term for life, it has no cash value and premium increase with age. For whole life, it's costly if you surrender early and usually have no cash value for at least for the 3-5 years, may not meet your short-term needs. By universal life, it has the same as whole life, but it has greater risk due to program flexibility, and it has low interest rate that can affect cash value and premium. The options may be renewable or convertible to a whole life policy, may pay dividends, may provide reduced paid-up policy and partial cash surrenders, may pay dividends and for universal life, may pay dividends and minimum death benefits and partial cash surrenders permitted. Other types of life insurance policies, for example, include the following. The group life is basically a version of term insurance, cover many people under single policy, and people included in the group do not need medical examinations to get the coverage. It is usually offered to employers. Okay, this is the typical. When I was with BMO, Royal Southern Line, Service Canada, they give me a group life coverage, who pays part of the cost to their employees, and through professional organization will allow members to sign up for the coverage. Credit life insurance is used to pay for certain debt, such as auto loans or mortgage, if you die before they are paid in full. So this credit life, you own a mortgage, you can use the credit life insurance. And then endowment life insurance provide a coverage for a specific period and paid an agreed upon sum of money to the policyholder if he or she is willing to end of the endowment period. Selecting provision of buying life insurance. Number 3, key provision in life insurance. Naming your beneficiary is very important. As your beneficiary receives the message of your life insurance policy, you can also name contingent beneficiary. Objection. There's also a constantability cost. Says the insurers cannot cancel the policy if it has been forced or associated period 0 to 2 years. There's also grace period allows you 28 to 31 days to elapse. During this time, you may pay the premium without a penalty, but after this period collapse, if the premium has not been paid. Okay, if the policy will lapse if the premium has not been paid, that's the key. The policy in the statement occurs when a lapsed policy is put back in the force, but you must again qualify for as an acceptable risk. That's the key part. Credit risk, that's another issue. Acceptable risk is one of the issues as well. And non-feature clause allow insurers not to forfeit all featured benefits. Okay? Continuation of this. There is also key provision on life insurance policies such as misstatement of age provisions. Say the company finds out that your age was overstated, it will pay benefit your premium would have been void if your age has been corrected. You have to put the exact correct age. That's the key part. Policy loan provisions permit you to borrow any amount up to the cash value of the policy. Suicide clause states that the first 2 years of coverage, beneficiary of someone who dies by suicide receives only the amount of premium paid. After 2 years, beneficiary receive full benefit of death benefit. So this is a suicide clause. That's the key part there. Okay. Riders to life insurance policy. An insurance can change the condition of policy by adding a rider. a document that modifies coverage. A waiver of premium disability, example, allow you to stop paying premiums if you're totally or permanently disabled before you reach a certain age, such as 60. Accidental death benefit, which is double indemnity, pays twice the value of the policy if you're killed in an accident or but the accident must occur before a certain age, generally between 60 to 65. Expert counsel against adding to the rider of your coverage. Guaranteed insurance private premium option allow you also to buy a specific additional amount of life insurance of a certain interval without undergoing medical exam. Okay, this is good for people that who are needing for more life insurance in the future. Okay, cost of living protection as well is designed to help prevent inflation from eroding the purchasing power of the protection against your policy provides. The accelerated benefits are life insurance policy proceed paid to the policyholder who is terminally ill before he or she dies. Second to die option, which is insurance to life, to live, usually husband and wife, damage is paid with the second spouse dies. Okay. Effective inflation of 100,000 insurance policy. Assume here 3% and purchasing power after given number. The x-axis will be 5 years period. The one is y-axis is percentage. Okay, it will show you 5 years here, all the way to 10 years, 15 years, and 20 years, which is because you have an inflation rate of 3%. It shows you a purchasing power after a given number of years there. This shows you the fact, basically it shows you the fact of inflation on 100,000 in life insurance policy. Okay. Buying life insurance, from whom you buy? You should consider a number of factors when you buy life insurance. As discussed in this chapter, these factors include the present and future sources. Okay. You must look for the coverage from finding strong companies with professional qualified representative. You make sure the company that you buy insurance from is have a good reputation, is financially stable. Okay, the sources will provide protection. It's from a wide range from policy and public sources. You also need to go to a rating agency, rating insurance company. Locate insurance company by checking its reputation of the local agency as well. Ask member of your parents or family colleague about which insurance they prefer. And then, of course, you need to choose your insurance agent, help you to select a kind of protection with your boundaries. Okay. This shows you a rating from major rating agency, Exhibit 10.5, 10/5 from Superior, from AM Best, Standard Poor and rating, Duff and Helps, Moody's, and Wish Research. So these are the things. These are the 4 agencies that you're gonna use to rate the companies that you will buy the insurance company from. Okay, Superior, which is A plus here, A plus plus, excellent will be A, good will be B plus plus, adequate will be B. So you're gonna depends on which rating you're gonna use this one. Most people use this 1, 2, 3, 4. Most the one that I usually use the most is Standard and Poor or Moody's. Okay, Wish Research you can also use. Okay, all AM Best. Give you an example here for below average will be C plus, weak is C, non-viable EF. So you have to make sure your insurance company that you choose has a good rating. If not, it's going to be a junk bond. Okay, you cannot honor it when you are want to cash in. Okay, buying life insurance. That's a key part. Number 1 is comparing policy costs. There's 5 factors that price the price of a company just for life insurance policies, such as the company of course doing business, returns on its investment, mortality rate among its policyholders, and features of the policy contains, and competition among companies with comparable policies. And then obtaining and examining policies. Life insurance policy is issued after you apply for insurance and the insurance company accept the applications. After you buy new life insurance, you have a 10-day to free look period during which you can change your mind. Okay, let's continue. Let's go back here. This is where we are. We just accident split. And using settlement options, the most common type of settlement will be a lump sum or limited installment payment, or life income options, or proceed left to the company. See, so let's look at step by step. Lump sum payment is when the insurance company pays the face amount of policy in one installment to the beneficiary or to the estate fund of the insured. This is what I prefer the most. Lump sum payment. 1 million is 1 million. Okay. Limited installment payment, provide payment of the life insurance policy in equal to periodic installment for a specified number of years after your death. Okay, you don't want to do that because it's going to be partial payment, installment. Okay, but I prefer the lump sum payment. Under the lifetime income options are made to the beneficiary as long as he or she lives. Or proceed left with the company is an option where the life insurance proceeds are left with the company at a set rate of interest. So you don't want to do that. Okay, I recommend the lump sum payment. Always remember, think twice. If your agent suggests that you replace the whole life or insurance life insurance that you already own. Always think twice. Okay, guys, make sure you are properly served. Okay, objective number 4. Financial planning with annuities. What is an annuity? It's a contract that provides a regular income for as long as the person lives. Immediate annuities means provide income payment at once and are usually purchased with lump sum payment. Deferred annuity provide income payment at some future date, meanwhile interest accrued on the money you deposited. A deferred annuity purchased with a lump sum payment is known as a single deferred annuity. Okay? And then index annuity have an earnings that accumulate at a rate based on the formula linked to one or more equity-based index such as S&P 500. As you have seen so far, life insurance provide a set of lump sum at your death. If you want to enjoy benefit if you're still alive, you may consider annuities. An annuity protect you against the risk of outliving your assets. So if you live longer, let's say you're supposed to live by 80 years old, but you live longer up to 100 years, maybe you're going to deplete your assets. Okay? Why buy annuities? A primary reason for buying annuities is to give you retirement gain for the rest of your life. You should try to fully fund your IRA, costs, and 401 before considering annuities. Appeal to variabilities such as increase during mid-1990s due to rising stock market. A fixed annuity states that the annuitant person will receive a fixed amount of income over a certain period for their life. Variable annuity, the monthly payment vary because they are based on the income received from stock or other investments. Some growth in their use of annuity can be credited to the passage of ERISA of 1974, which is Employment Retirement Income Security Act. This is in US, okay? It's not in Canada, the law. Tax consideration, let me just go back. It's just tax consideration when you buy annuity. Interest on the principal as well as interest compounded on the interest build up free and for income tax. Tax Reform Act 1986, all this is for the US side. Okay? If you die during a claim period, your beneficiary is guaranteed no less than the amount invested. Drawbacks include reduced flexibility and fees that lower investment premium. So that's basically this. Canada has a different act, okay? I don't have the exact detail of the Canada one, but as soon as I found out, I will let you guys know. Alright, that's the chapter summary of 10.1. Basically, number 1, define life insurance and determine your life insurance need. Why? Because life insurance protect the people who depend on you from financial loss because of your death. You can always use any method, easy method, DING method, non-working spouse method, or family need method to determine your life insurance need. That's the summary of the objective number 1. Objective number 2, distinguish between type of life insurance company and analyze various life insurance company of this company is used. There are 2 types of insurance companies are stock and mutual and sell and non-purchasing and purchasing policies. Both 2 basic types of insurance such as term life and whole life. Many variations and combinations of these types are available. Okay, that's summarize of objective number 2. Objective number 3, select the important provision in life insurance contract and create a plan to buy life insurance. What are those? Most of life insurance companies have standard features, and the insurance company can change the condition of policy by adding a rider to it. Before buying life insurance, consider all present and future sources of income, then compare the cost and choose appropriate settlement options. Number 4, chapter summary, recognize how you provide financial security such as an annuity pays while you live, whereas life insurance pays when you die. With a fixed annuity, you receive a fixed amount of income over a certain period of life. With variable annuity, the monthly payment varies because they are based on the income received from stock or other investment. This basically concludes this chapter, so I will upload this in YouTube as well as and Edpuzzle for your interactive learning process. Thank you, everyone. Bye-bye.